Hello everyone, I'm Balram, and today we have a very special guest with us, Matthew Peterson. He's our fund manager at Peterson Capital Management. Today we're going to discuss the fascinating interplay of psychology and investing. So let's dive right in. Matthew, why is psychology important in investing?
Well, Balram, that's a great question. You see, investing isn't just about numbers and charts. It's about people, and people are driven by their emotions and psychological biases. This is where the amygdala comes into play. The amygdala is a part of our brain that's responsible for our fight or flight response. It's a primal part of our brain that's been with us since our ancestors were hunting and gathering in the wild. It's designed to keep us safe from immediate danger, like a charging lion or a falling rock.
But we're not facing those kinds of dangers when we're investing, right?
No, Balram, we're not. But the amygdala doesn't differentiate between a physical threat and a perceived financial threat. When we're faced with a risky investment, our amygdala might trigger a fear response, causing us to avoid the risk. But as we know, in investing, sometimes taking calculated risks is necessary.
Can you give us an example?
Certainly. Consider an irrational investor, Jane, who has done thorough research and is set to invest in a promising stock. Yet alarming market volatility headlines stir her amygdala into a fear response, releasing cortisol and stress hormones and causing physical symptoms. This fear makes her question her decision. Despite her logical analysis, Jane decides not to invest, keeping her savings in a low-interest account, and as a result, she loses purchasing power against inflation. Jane's amygdala, in trying to protect her, prompts an irrational decision from a financial perspective. Jane's fear response leads her to miss a valuable investment opportunity. Balancing inherent fear with rational analysis is essential for wise investment choices in our modern world. But here's the thing. While cash doesn't fluctuate in price, it does not offer the same growth potential as in solid value investment. So by giving into your amygdala's fear response, you might miss out on a potentially lucrative investment.
Interesting. So how do we overcome this fear response?
That's where Daniel Kahneman's System 1 and System 2 thinking comes into play, but we'll get to that in a moment. Kahneman, a Nobel laureate, has done extensive work in behavioral finance and identified two different systems that the human brain works with. System 1 is our intuitive, automatic, and fast way of thinking. It's driven by our emotions and biases. It's the system that makes you flinch when you see a scary movie, or makes you feel good when you smell your favorite food. In the world of investing, System 1 might make you feel excited when you hear a hot stock tip at a party, or make you want to sell all your stocks when you hear bad news about the economy.
So it's like a gut reaction?
Exactly, Balram. But while gut reactions can sometimes be helpful, they can also lead us astray, especially when it comes to investing. That's where System 2 comes in. System 2 is slow, deliberate, and logical. It's what we use when we make calculated decisions. It's the system that you use when you're planning your budget, analyzing a company's financial statements, or deciding on your long-term investment strategy.
Can you give us an example of how these two systems might conflict when making an investment decision?
Certainly. Let's say you've been following a particular company for a while. You believe in their product, you've analyzed their financials, and you've decided that they're a good long-term investment. That's your System 2 at work. But then, one day, the company's stock price takes a big hit due to a bad earnings report. Your System 1 might kick in and make you feel panic. You might be tempted to sell your shares and cut your losses. But if you actively engage your logical System 2 thought processes, you might realize that the fundamentals of the company are still strong, and that the drop in price might actually be a good opportunity to buy more shares at a discount.
So the key is to balance our instinctive reactions with careful analysis?
That's right, Balram. It's about knowing when to trust your gut and when to take a step back and look at the bigger picture. And that's a skill that can be honed with time and experience. And speaking of looking at the bigger picture, this brings us to another important concept in behavioral finance: loss aversion.
Loss aversion, that sounds ominous.
It might sound ominous, but it's a very human reaction. It's actually closely tied to what we've been discussing about System 1 and System 2 thinking. Let's explore it a bit further. Loss aversion is a concept that was first identified by Daniel Kahneman and Amos Tversky. It's the idea that people feel the pain of a loss more acutely than the pleasure of an equivalent gain. In other words, losing $100 hurts more than winning $100 feels good.
How does that apply to investing?
Well, in investing, loss aversion can manifest in several ways. For instance, investors might hold on to losing stocks for too long, hoping they'll bounce back because they can't bear to realize a loss. This is known as the disposition effect.
Can you give us an example?
Sure. Let's say you bought shares in a company at $50 each. Over time, the price drops to $30. Instead of cutting your losses and selling, you hold onto the stock, hoping it will go back up to $50. That's loss aversion in action. You're avoiding realizing a loss, even though it might be more rational to sell and invest in a more promising opportunity.
And what's the opposite of that?
On the flip side, investors might sell winning stocks too soon to lock in gains and avoid the possibility of future losses. This can also be a result of loss aversion. For example, if you bought a stock at $50 and it rises to $70, you might be tempted to sell and lock in your gains, even if the company's prospects suggest it could rise further.
So, how can investors overcome loss aversion?
One strategy is to focus on your overall portfolio performance rather than individual gains and losses. It's also important to have a clear investment plan and stick to it, rather than making decisions based on emotions. Remember, investing is a long-term game, and temporary ups and downs are part of the process. And while we're on the topic of emotional decision-making, it's worth noting that our decisions can also be influenced by those around us. This brings us to another psychological concept that plays a big role in investing: social proof.
Social proof, like following the crowd?
Exactly, Balram. It's a powerful force, and it can have a big impact on our investment decisions. Let's delve into it. Social proof, a term coined by psychologist Robert Cialdini, refers to the tendency to see an action as more appropriate when others are doing it. In other words, we're influenced by what others around us are doing.
And how does that relate to investing?
In the world of investing, social proof can lead to what's known as herd behavior. This is when investors follow what everyone else is doing rather than making independent decisions based on their own analysis. For example, if everyone is buying shares in a particular company, other investors might feel compelled to do the same, thinking that there must be a good reason for the buying frenzy.
That sounds like it could be risky.
Indeed, it can be. Following the crowd can sometimes lead to investment bubbles and crashes. A classic example is the dot-com bubble in the late 1990s. Many investors, seeing others pouring money into internet companies, decided to follow suit, often without fully understanding the value or business model of the companies they were investing in. When the bubble burst, many people lost a lot of money.
So how can investors avoid falling into the trap of social proof?
Avoiding social proof traps is all about maintaining your independence as an investor. Here are a few strategies that can help. 1. Do your own research. Don't invest in a company just because everyone else is. Take the time to understand the company's business model, financial health, and growth prospects. Look at its earnings reports, read news articles, and consider its position within its industry. 2. Have a clear investment plan. Know your investment goals and risk tolerance. This will help you make decisions that align with your personal financial situation and goals, rather than being swayed by what others are doing. 3. Diversify your portfolio. Don't put all your eggs in one basket. By spreading your investments across a variety of companies and sectors, you can reduce the risk of a single investment hurting your overall portfolio. 4. Be patient. Investing is a long-term game. Don't be swayed by short-term trends or temporary market fluctuations. Stick to your plan and be patient. 5. Seek professional advice. If you're uncertain about an investment decision, don't hesitate to consult with an expert. A fund manager or knowledgeable wealth advisor can provide a more objective view. Be mindful, however, to ensure they are truly experts and not just perceived as such due to their popularity or charisma. Remember, the goal of investing is not to follow the crowd, but to make informed decisions that align with your financial goals. While we're discussing the influence of psychological factors on our investment decisions, it's worth mentioning the work of two other influential figures in behavioral economics, Richard Thaler and Dan Ariely.
I've heard of them. They've done some interesting work on irrational behavior, right?
That's right, Balram. Their research has shed light on some of the irrational behaviors that investors can fall prey to. Let's explore some of their insights. Richard Thaler and Dan Ariely are two leading figures in the field of behavioral economics, which combines insights from psychology and economics to explain human behavior. They've done a lot of work to show how our irrational behaviors can impact our investment decisions.
Can you give us an example?
Certainly. One of Thaler's key contributions is the concept of mental accounting. This is the tendency for people to divide their money into separate accounts based on subjective criteria, like the source of the money and its intended use. For example, you might treat your bonus money differently from your salary money, even though rationally speaking, money is fungible. In the context of investing, mental accounting can lead to some irrational behaviors. For instance, you might be more willing to take risks with money that you won't or that was unexpected, like a bonus or a lottery win, than with money that you've earned through hard work. This could lead to an unbalanced portfolio or unnecessary risk-taking. Ariely's work also provides valuable insights. One of his key findings is that our decision-making can be easily swayed by how options are presented to us, a concept known as framing. For example, an investor might feel differently about a decision framed as a loss versus the same decision framed as a foregone gain. In investing, this could mean that an investor might be more likely to sell a stock if they're told they're losing 5% compared to being told they're missing out on a 5% gain. Even though the end result is the same, the framing can significantly impact the decision.
So, what's the takeaway, Matthew?
To protect ourselves from these biases, we need to be aware of them and actively work to counteract them. Here are a few strategies. 1. Be aware of mental accounting. Recognize that money is fungible, regardless of its source. Whether it's your salary, a bonus, or an inheritance, all money should be treated the same when it comes to investing. Don't take unnecessary risks with money just because it feels extra or unexpected. 2. Consider the framing. Be aware of how information is presented to you. If an investment decision is framed in terms of losses, try to reframe it in your mind in terms of gains, or vice versa. This can help you make more rational decisions. 3. Use a decision-making framework. Having a structured process for making investment decisions can help reduce the influence of biases. This might involve conducting a thorough analysis of each investment opportunity, weighing the pros and cons, and considering the potential impact on your overall portfolio. 4. Seek a second opinion. Sometimes it can be helpful to get an outside perspective. A financial professional or a trusted friend or family member can provide a fresh look at your investment decisions and might be able to spot biases that you've overlooked. 5. Regularly review your investments. Regularly reviewing your portfolio can help you spot and correct any biases in your investment decisions. This might involve checking your portfolio's performance, reassessing your investment goals, and making any necessary adjustments. Remember, the goal of investing is not to eliminate emotions or biases entirely. That's impossible. Instead, the goal is to manage them effectively so they don't negatively impact our investment decisions.
These insights are truly fascinating, Matthew. It's clear that understanding our own psychology can be as important as understanding financial markets when it comes to investing.
Absolutely, Balram, and that's a perfect note to wrap up our discussion, shall we?
Well, that's all the time we have for today. Thank you, Matthew, for this enlightening discussion.
My pleasure, Balram. Remember, investing is not just a financial journey, it's a psychological one too.
Well said, Matthew, and thank you all for watching. Until next time, keep learning and happy investing. This video was created using ChatGPT 4, Photoleap, ElevenLabs, Studio DID, and Adobe Premiere Pro.